Okay, let's continue from what we were talking in our last class. In our last class, we looked at various things like significant economic presence was discussed in my last class with you. And I hope you guys have watched the last video. Okay, so we can start the class now. So, and I hope you are reading all the class notes too that we are giving. We also did minimum tax last week, right? So last week I told you that tax could be in 4 different ways. Company could be assessed with tax in 4 different ways. Number one, I said company could be assessed with tax on dividend. Number two, I said on turnover. Number three, I said on total profit. Number four, and I said on minimum tax. So, thank you. So those are the 4 ways company could be assessed with tax. But we still need to look at some other aspect of company income tax before we start solving questions. That's what we want to look at today. Okay. Today we're going to be looking at we talked about this last week. That we're a company. Sorry guys, I'm so sorry. That when a company is a first business, the company will be given a bonus of 1% when it's a large company, when the company pays the tax liability on time. That is within 90 days after the accounting year. If it's a large company, if the company pays its tax liability, Jesus Christ, within 90 days after the accounting year end, the company shall be given 2% rebate, and this 2% shall be made available for relief in the subsequent year. That was what we discussed in our last class. So today, oh God. So we're going to be looking at profit exempted from tax. There are so many. Oh, excuse me. I'm so sorry. So profit exempted from tax, we're talking about friendly society. You must be registered as registered as friendly society, exempted, cooperative, exempted, church, mosque, they're exempted, companies formed to promote sporting activity, exempted, any profit made by trade union, exempted, profit made by distributed by unit trusts, exempted, any company being a body corporate established under local governments or edits, local government law edits in force in any state is exempted. So if a local government makes profit, is exempted. Any corporate organization being purchasing authority by an enactment and the power to acquire any commodity for export exempted. So there are so many profit exempted here. This is very important for your class. Dividend, interest, rents, or royalty derived by a company from a country outside Nigeria and brought into Nigeria through government-approved channel. For the purpose of subsection, government-approved channel means central bank, okay? So if it is brought in through there or second-tier market, such will be exempted from tax. Okay, having said that, we move on to the next one. We need to talk about what Finance Act introduced recently. Finance Act introduced this section, this one. And there are implications of that. Mr. Idris must have taught you this when he was dealing with specialized business. So let's look at it. Now, dividend. Start from here. Dividend. I'm in the class.
Can we watch on the TV?
Yes, you can.
Daddy said yes.
And close the door for me. So we are saying that dividend and rental income received by real estate investment company on behalf of the shareholder is exempted from tax. Exempted. There is provision to that, provided that at least 75% of the rental income and dividend income is redistributed to the shareholder, and at the same time, such distribution is made within 365 days. Okay, so it will be exempted. Do you understand me? There is a scenario question that Mr. Idris gave to you that must have given to you when you were doing your specialized business. This is a key topic that was discussed in that paragraph. So it is very important that you know that when a company is a real estate investment company, so any dividend, rent, and rental income distributed by them will be exempted from tax, provided that number one, such a dividend is distributed, at least 75% of it is distributed, and at the same time, the distribution must be done at least 12 months, within 12 months after the income was earned. Within 12 months after the income was earned. So that is that. So such will also be exempted from tax. So the profit of the company established within free trade zone, export processing zone, is exempted from tax. Excuse me. Is exempted from tax. And that is why most companies usually go to free trade zone to go and establish their business to get tax holiday or tax advantage. And that is why when most companies want to invest in your country, one of the things the country or the company start looking at is your tax laws. How would it affect their business? So they usually look at that. So that's it. In the absence of no question, we'll move on to the next one. Now, deduction not allowed. We have talked about that when we're doing our trading profit and loss adjustments. But we need to now look at one of the deductions allowed, but we want to look at it in details. One of the deductions allowed is donation. We know that donation is allowed, okay? But there are criteria to which donations will be allowed. Number one, according to 2007 amendments. Okay, donation can only cannot be of capital nature. Donation cannot be of capital nature. So a company that has made donation cannot say it is capital. You want to give them capital item. No, it is not allowed. Okay. But again, after that 2007, I think 2011, there was also an amendment that came and said donation can be of capital in nature, provided the donation is to research and development company and educational institutes. So it could be capital in nature, provided it is to research and development company or to educational institutes. Okay, so that is that. Do you have any question? The next one that is very key is that donation shall not be more than 10% of the total profit of the company. Donation shall not be more than what? 10% of the total profit. You can see of the company in the year of assessment. So exemptions also came and said no, donation can be more than 10%, provided you have donated to educational institute. So what is the criteria for that? Donation of total profits or 25% of tax payable, whichever is higher. So we are saying that donation ordinarily, if it is to a company, it cannot be more than 10%. But we are now saying that if it is to to research and development company, it could be more than 10%. Okay, but the maximum is also 15%. In that 15%, the donation cannot. So we're not going to be considering or comparing the higher of what's it called? The higher of 15% of total profit and 25% of tax payable within the year. So that will be the donation you can make to the company. The next one, a company that is making loss cannot donate. Therefore, donation can only be made out of profits. A company that makes loss cannot make donation. Why? You don't have money, you are still making donation. It's not possible. So donation can only be made out of what? Profit. Donation can be made out of profit. So any company that makes loss cannot actually make donation. Having said this, we can move forward. Now, it should be noted that during COVID, there was this donation that was introduced by government. Before we go to that, let's talk about the broad category of donation. Now, for broad category of donation, donation could be made to statutory bodies or institutions It could also be made to ecclesiastical, charitable, educational, and scientific institutions. Now, these are the list of bodies to which, if you make donation, such donations will be allowed. If you make donation to this kind of bodies, the donations will be allowed. Now, the first one is Boy Scout, Girl Guide. Now, how do you identify all this in the exam? Any donations that has research and development in it, allow it. Are you getting me? Any donation that carries national coloration, allow it. Okay? But you cannot. So when I say religious organization, the act specifically says Muslim, Association of Nigeria, and Christian Association of Nigeria. That is the one we are talking about. But I think from the new amendment they are trying to do now, you can make donation to your church. But let's see how that one goes. It should not be to can again. You can make it to your church. But let's see how the new amendment will affect donation. Okay. So the next one is any donation that carries a welfare coloration too. For example, when I donate to Guest Guide, Boys Brigade, Girls Brigade, Red Cross, all those things will be an allowable donation. Note, when you make donations to ICAN, it is not allowed. But when you make donations to ICAN Building Fund, then your donation will be allowed. You can see the difference. Making donation to ICAN according to the Act is not allowed, but when you make donations to ICAN Building Fund, such will be allowed. Okay. If you are there, I am there. The next one I was going to be talking about now is what is the Finance Act implication of donation made by company during pandemic? Finance Act implication of a donation made by company during pandemic. Now, during COVID, there were a lot of problems that happened in the country to the extent that people could not as they began to have issues with regards to what is happening in the country. Like the pandemic really affected a lot of businesses. And to the extent that a lot of people could not even go out of their houses to go and perform their civic responsibility or what would bring food to their table. So what did government do? Some companies want to make donations to that cause, but that was not in the act. And when you make donations to that cause, you might not really be allowed to claim it. Okay. So what they now did was to say, okay, government quickly during that 2020, they made a provision in the act that if a company make donation, whether in cash or in kind, when I mean in kind, maybe you manufacture something and you donate it to government, okay? Such donation shall be allowed. Such donation shall be what? Shall be allowed. So that means the government permits, I can't hear anything at my end. Mr. Willington. Mr. Wellington.
Good morning, sir. Good morning, sir.
Okay. Can you hear now?
Loud and clear, sir. Loud and clear, sir.
Okay. So as I was saying, so government deliberately set up a fund and says anybody that makes donation into this fund and any other similar fund with regards to natural disaster, pandemic, or any other exigency, such donation will be an allowable deduction. Such donation will be an allowable deduction. Now, Anna said that during this situation, your donation could be in kind, or it could be that you have manufactured. You could give government cash, or you manufacture goods and give it to government. You remember during COVID, Albert Igwe gave 1 billion to government under the Access Bank regime. He gave 1 billion. Not only him, some other companies too gave money to government to cushion the effects of this COVID on the livelihood of people and businesses. So they gave government money. Or some companies like Indomie, I know of Indomie. Indomie began to manufacture Indomie or noodles and gave it to government so that people can have food on their table. So what Yan is saying is that if this occurs, such a donation by the company shall be an allowable deduction. Now, what are the conditions? Number one condition is that the donation shall not be more than 10% of accessible profit. Number two is that the donation shall be first in, first out. What do I mean by that? The donation shall be first in, first out. What it means is that when you make donation now, when you make donation of this year, let's say you make donation of 20 million this year. In year two, you make donation of 30 million. In year three, you make donation of 10 million. We are saying the first donation that you make, you must first relieve it before you consider the second one. So if you are unable to relieve this for 2 years, then it becomes lapse. So what we are trying to say here is that your donation shall not be more than 2 years for you to be able to recover it from your profits. And what is very important in this one is that the donation is made shall not be more than 10% of accessible profits. The other one I said it should not be more than 10% of total profits. This one is to accessible profits. And it is very essential that where a company needs to claim donation with regards to exigency and also to claim donation with regards to section 25 and schedule 5 of CETA. The one that comes first is this donation during exigency before you talk about that of the total profit, because the Act already arranged it in such a way that this will come first before the other one. Okay? So That is that. Do you have any question? Now, by implication, the act says the donation will not be more than 10% of my total my accessible profit. How do I calculate that? If you have your study material, you can open it. I want to go to white marker board. Okay? And if you have my textbook, you can also open it while you. I want to go to white marker board. That's so that I can really write this. If you are there, I am there. Okay. So as I was saying, imagine.
Sir, please can someone send the material to the group chat? Thank you.
Please help me send the group chat. So I said, can someone send my chat to the group chat, please? Okay. So how do you calculate your donation? Oh, what's happening? Sorry, guys. How do you calculate your donation during exigency or pandemic? We have said the donation shall not be more than 10% of accessible profit. But unfortunately, 10% of your accessible profits, you cannot get it without doing some manipulation. So to calculate that, you have to do 10% over 110 multiplied by accessible profits before donation. So imagine the accessible profit before donation is 110,000. Okay. So my donation will now be 10,000 by the time I calculate it. So to get my accessible profit, I can now say my accessible profit before donation is 110. Okay. Donation will be 10 over 110 multiplied by 110. You have 10,000. If you subtract it, you have 100,000. This is your accessible profit. So if I say 10% of my accessible profit now, I will have my 10,000. Do you understand what I'm explaining? I said to ascertain your donation during exigency, the act says it should not be more than 10% of accessible profit. Abi? That means if you have any donation before now to companies that you have made donation due to pandemic to governments, that donation will first be disallowed. It will first disallow it. Let's assume you have made donation of 40,000. This donation of 40,000 that you made will first be disallowed. So that would have been part of this to get accessible profits. You will now calculate your donation, which is 10 over 110 multiplied by your accessible profits. You have your donation So we are now saying, look at the donation this guy made, 40,000. But look at the donation you calculated.
Hello, sir.
Yes, go ahead.
Why are they doing over 110? Why not over 100?
It can't be over 100.
1.5.
You will not get. So if I had done over 100 here, I would have gotten 11,000. Have you? So subtract 11,000 from this. I will get, what will I get? 99. Have you? 99. If I say 10% of 99, it gives me 9.9. But meanwhile, this 10% here, I must get whatever I have here when I do 10% straight is the same that I will have here. Do you understand me? Let me explain so that you can get what I'm saying. Let's explain. So I am saying, for the purpose of for the purpose of calculating your donation, your formula will always be 10 over 110 multiplied by accessible profit before donation. That is your formula. Excuse me, guys. Okay, so your formula is always 10 over 110 multiplied by your donation, your accessible profit before donation. So I am now saying, let us assume your accessible profit before donation is 110. So for me to get my donation, I'll say my donation allowable is 10% of the 110. I will get 10,000. By subtracting, this is my accessible profit. I will have 100,000. So if I now say 10% of this my accessible profit, I will have 10,000. So the other one that you are saying, you can see that this guy and this guy, they are the same. If we are done the way you have suggested the other time, you don't have the same answer. And that is not the intention of the law. Okay? So that is that. We'll move on. The next one that we're going to be talking about now is the Finance Act implication.
Sorry, excuse me. If the accessible profit was 120, that would have done 10 over 120.
No. Okay. Who is that? Is that Bessie?
Normal.
Normal.
Yes, sir.
Okay, let's explain that again. Okay. It is not going to be what you have just said. Assuming that the accessible profit was 120. Okay. Accessible profit before donation. My donation will be one. I have to do that so that it will be easier for me. Okay. It's not, there is, now we have to press the calculator to get my answer here. So what would my answer be? Give me my answer. You know,
I'm
10,909.09.
okay. Yeah.
10,000.
10,000. 10,000.
909.
I can't do the 09. What is it? 909.
909.
Okay.
Yeah.
10,000.
So, accessible profit. What do you have? We have 10,909 something. What do you have?
9191.
If I do 10% of 10,000, I'll have the same. Do you understand me? So it's not because this was 110 the other time. That was why I had to do 1 over 1. The standard is this. Do you understand me?
Yes.
Good.
Yes, sir. Thank you.
The next one that we're going to be looking at is Finance Act implication. I hope you guys are always jotting down of expenses incurred in deriving tax exempt income. What does the act say here? The act says that if you have an expenses, if you have an income, income that is exempted from tax, about any expenses incurred on such income shall be exempted or shall not be allowed as deduction. Do you understand it? So we have already said the income is tax exempt. If the income is tax exempt, that means the expenses that we use in generating that income will not be allowed. So this is what I'm trying to say. Imagine a company makes an income of 100 million full time. Out of this income, we were told that 35 million relates to profit on disposal. Okay? And you're now told that total expenses is 37,500,000. And these expenses includes 75 advertisement costs for the assets disposed. Let's go. Look at what we said. The total income of the company is 100 million, right? And the total expense of the company is 37,500. Unfortunately, this company made out of this total income, 35 million was profit that is exempted from tax. We all know that profit of disposal is exempted. So we are saying if this 35 million is exempted from tax, any expenses attributable to this 35 million will also be what? Will not also be allowable as deduction. So if I want to calculate my adjusted profit, I'll say total profit of the company is 100 million. Abi, less profit on disposal, which will be 35 million. So taxable income of the company is 65 million. We go. So we want to determine allowable expenses of the company to allowable expenses. Total expenses, 37,500,000. Non-allowable expenses, that advertisement will not be allowable. Why? Because it relates to the disposal of fixed asset that is not taxable, right? So 75. Allowable expenses, 30 million. To calculate my profit or my adjusted profit, I'm going to have taxable income, which is 65 million. And allowable expenses, which is 30 million. Our adjusted profit will now be 35 million. So the implication of what we are trying to say is that any income incurred, any income generated, okay, and the act already says this income is not allowable. So if it's not taxable rather. So any expense incurred on tax exempt income, such expenses will not also be allowable. Why? Because the income is not allowable, it's not taxable rather. So you can't come and be using expenses of non-taxable income to be reducing our adjusted profits. It should not be allowed. So in your study pack, you have an illustration there. Let's look at illustration number 8. Before 8, let's look at 7, where we talked about the bank PLC secured a pool of funds which was invested in generating an income of 1 billion, which is exempt from tax. So 1 billion is exempt from tax. The bank incurred a sum of 100 million by way of interest, administrative, and other operating costs pertaining to the investment. The company incurred another 200 million by way of interest, administrative, and other operating costs in its other banking business to generate 2 billion, which is only tax exempt. You are required to compute the adjusted profit of the company. Number 1, the 1 billion is tax exempt. 1 billion. Number two, the 100 million is not going to be allowable. Why? Because it relates to 1 billion that is not that is tax exempt. Do you understand? But the 2 billion is from other banking. Yeah.
Can you please take that again? Thank you.
Okay. So I'll say that the 1 billion is tax exempt. Any expenses incurred in generating tax exempt income is not allowable. Therefore, the 100 million is not allowable. Even though you can see interest, administrative, and other operating costs, ordinary, those are supposed to be allowable. But the fact that the income that that accrues to us, and the fact that the expenses relate to this income that is already exempted, so all the expenses will not be allowed. Imagine a scenario in this same question where we generated 2 billion from other stream, and expenses incurred on that 200 million was 200 million, 2 billion. On the 2 billion income, we incurred expenses on what? Of you incurred expenses of 200 million. You now still brought expenses that is not related to this 100 million. Your adjusted profit now will be what? 1.7. What have you done to the government? You have shortchanged the government because you had an income that is exempted, which was 1 billion. 1 billion was exempted. So that means on this 1 billion that was exempted, you are taking the entire 1 billion away. And you are now using the expenses that you're supposed to have deducted from this one, even though you're not going to pay tax on this, to reduce this guy. You now brought it here to reduce the one you're going to pay tax on. That means you are cheating government. And that will not be allowed under the tax law. Any question? Any question? Any question? Okay, in the absence of none, let's go to the next question. Company XYZ Limited incurred 200,000 deductible expenses in generating business profit of 1 million. In the year. You were informed that the sum of 700 million of total business profit is assessable to tax 700 million. While the remaining 300 million is tax exempt. You are required to calculate the expenses that will be allowed for tax purpose. How do you do that? Although the solution is already there. It's a proportion, okay? So that means out of this your 100 or 1 million that you generated, 70% of it is allowable. So 70% of 200,000 is 140 is allowable. 30% of 200,000 is 60,000. It should not be allowable. So this is not allowable, and this is allowable. Do you understand? Why? Because they already told us that 70,000, 700 million out of that is for business expenses, Abby, and the remaining of 700, the remaining 300,000 is for 700,000 is for profit that is accessible to tax, while the remaining 300,000 is exempted, is tax exempt. So the one that is tax exempt, any expense incurred on it will not also be allowed. So we need to calculate that. But in this scenario, the examiner only gave us that 200 million was used in generating the 1 million. And that is why we need to first take that out. Okay? Do you have any question for me? Okay, in the absence of none, we'll move on to the next one. Is Olusoji in this class? Okay. Excuse me. Okay, we'll move on to the next one. Do you have any question on this? Do you have any question on this? Do you have any question on this?
No.
Abiola? Okay. Let me re-explain. We are saying that any expenses incurred in generating exempt income shall not be allowed. Okay? And that is what I've been saying. That if you incur an expenses on the income that is exempted from tax, such expenses will not be allowed. Okay? Do you understand that? So that's what we're trying to explain. Okay, sorry guys. I was actually attending to someone. Sorry, mute your mic. Mute your mic. Okay, let's go ahead. Do you have any question for me, guys? Can anybody hear me?
Yes, we can hear you.
Okay. So we'll move on to the next one. So the next one I'm going to be talking about now, which is very important because I have seen it in past questions, okay, is to talk about business reorganization and reconstruction. Business reorganization and restructuring. Business reorganization and restructuring. You know, I told you that this topic is half theory, half calculation. So if you don't know theory, it's a problem. So you have to always follow. Now, when you talk about business reorganization and restructuring, we are only talking about when a Nigerian company is sold to another company for a better reorganization. We are saying where a trade or business is sold or transferred to a Nigerian company for a better reorganization. For a better reorganization. Okay. The entity shall qualify for some certain concession. So, when a Nigerian company is sold to another company, okay, for a better reorganization or restructuring, such a company would have the following concession. Okay, what are the concession? The concession will be that the companies will not be commencement rule and cessation rule shall not be applied to the companies. Okay, that is the company that is taking over the other company and the company that is selling to the other company, the two of them, both commencement rule and cessation rule will not be applicable to them. That's number one. You must know these conditions, concessions. So because the examiner will ask you, what are the concessions that will be applicable to a company where the company is reorganized or restructured? Number one, commencement rule and cessation rule will not be applicable. Number two, assets taken over shall be at their tax losing down value. Asset taken over shall be at the tax losing down value. Okay? What about next? No capital gains tax. The applicable capital gains tax. No applied net transfer. Do you understand it? So, as I was saying, I said where a company is reorganized for a better repositioning or for a better management, the Act gives such a company the following concession. Number one concession is that the company will not, commencement rule and situation will not be applicable to the company. Number two, asset taken over by such a company shall be taken over at their tax losing down value. Number three, no capital gains tax will be applied on the transfer. Number four, no value added tax will be also what? Applied on the asset transfer. Now, this topic that we are talking about, also this transfer is also under capital gains tax as a topic, is under company income tax as a topic, and is also under capital gains tax and value added tax as a topic. So the same rule is applicable. Now, what are the conditions? Conditions for the taxpayer to qualify for these concessions. Number one, the taxpayer must apply or the taxpayer must seek the consent of FIRS. You must seek the consent of the FIRS. Number two, the companies must prove to the satisfaction of the board of the service, rather, that they are connected. Connection is very important. The company must prove to the satisfaction of the board of the service that they are connected. What is connection? What is, when we say companies are connected, what does that mean? They are related. And this relationship, this connection or relationship must not be less than 365 days before the assets were transferred. Do you understand me? It will not be what? Less than 365 days they must have been connected at least before the asset is taken over. Before they do the transfer, the connection must not be less than 365 days before the takeover took place. So that means at least 1 year before they talk about transferring assets, such a company must have also be related for at least 365 days. Excuse me, guys. So let's continue. Any question? Any question? Now, these conditions, condition number 4, the assets taken over cannot be disposed within 365 days. Okay? After the transaction. So what we are trying to say here is that if you are taking over the assets, you cannot also transfer it. You cannot sell it within 365 days. This one we said the company must have been connected at least 365 days before the takeover. We are now saying number next is that the asset that you are taking over, the money that you are taking over, the business that you are taking over, you cannot transfer it again to another company within 365 days. Do you have any question for me? Okay. In the absence of none, we move on. So that is that. Do you have any question before we move on? Let's quickly recap. Business reorganization and restructuring. This will occur where a business is transferred from a company to another company for a better reorganization. And the entity will be given the following concession under the tax law. So, number 1, the company will not be assessed to tax using the commencement rule and the cessation rule. That's number 1. Number 2, assets will be taken over at their taxing down value. Number 3, no capital gains tax will be applicable on the asset disposed. Number 4, no value-added tax will be charged on the asset disposed or transfer. We now said before these concessions will be granted to the taxpayer, the taxpayer would also must also fulfill the following condition. Condition number 1, you must seek FIRS concurrence before you go into this process. Okay, FIRS must be in the know. They must know. Number next, the person must prove to the satisfaction of the board that they are connected. There is connection. One company controls the other is controlled by the one that is controlling the other. Okay, there must be connection. Related party transaction is very important. Number next is that the connection between these parties must be at least 365 days before the reorganization. Number 4 is that these assets or this business cannot be transferred to another company within 365 days after the transaction took place. If the taxpayer does this, then all the tax that is supposed to have paid that did not pay because of the fact of the concession that they have been given will be paid. The penalty will be paid. Interest will be paid. So that is that. If you have any questions, ask. The last discussion for today is reconstituted company. What is a reconstituted company? A reconstituted company is a company or business that is previously being carried on by a foreign company and transferred to a Nigerian company. A reconstituted company is a company carried on in Nigeria by a foreign company, and the assets or the business and the management is transferred to a Nigerian company. So we are saying a reconstituted company is a company that was being carried on by a foreign company and later on transferred to a Nigerian company. Concession. Number one, no commencement rule. And cessation rule will be applied. Commencement rule and cessation will not be applied. Number two, they are similar anyway. Number two is that the asset taken over will be at tax down value. Number three, losses can be carried forward for a maximum period of 4 years. That is, loss of a reconstituted company can be carried forward for a maximum period of 4 years. Number four, no initial allowance and annual allowance will be granted. No initial allowance will be granted. Annual allowance will be granted shall be on the tax down value of the assets. Okay? So that's that. What are the conditions? Conditions for you to get this concession. FRS must be involved. You must carry them along. And number two, the business to be carried on by the reconstituted company must not be materially different from the foreign company. Do you understand? Number one, we said you must inform FRS. Number two, because you are saying you are taking over the business that is being run by the foreign company, therefore, your business must not be different from that of the foreign company. That is that. Okay? So, that is that. In our next class, I need to go somewhere. I have a meeting now. But in our next class, by the grace of God, we'll likely finish this class by next week. We are going to be talking about, if you have any question, please ask now. We are going to be talking about the implication, Finance Act, implication of interest deductibility. That's going to be our next topic. And after I'm able to cover all this, then we will now solve past questions. So next week, by the grace of God, we are solving at least 2 questions from past questions. Now, the reason why I needed to do all this theoretical part is because you are in professional class and they are very important for the success of this your course. Because if you do not understand all this theory, by the time you begin to see them, it will be looking strange. And I don't want a situation whereby all that we're supposed to have taught you, we did not teach you, and just allow you to go to the example like that. So that is that. If you have any question, please ask me. Okay, in the absence of none, we'll meet again next week, Saturday. Good day to you.